and welcome to the Q1FY25 earnings Shalby Ltd conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kashish Thakur from Elara Securities Private Limited. Thank you, and over to you, sir.
Thank you, Sabha. A very good evening to all of you on the call. On behalf of Elara Securities, I, Kashish Thakur, welcome you to the management call of Shalby Ltd to discuss Q1 FY25 earnings and business outlook. We have the top management team of Shalby present in the call. I'll now hand over the call to Mr. Jigar Todi from IR team of Shalby for his opening remarks and taking it further. Over to you, Jigar.
Thanks, Kashish. Good afternoon, everyone. Our earnings presentation is uploaded on the stock exchange website and our company website, shalby.org. We do hope you have already had the opportunity to go through the presentation. Please note that some of the statements made in today's call may be forward-looking in nature and may involve risks and uncertainties. Kindly refer to slide number 37 of the investor presentation for a detailed disclaimer. Now, I would like to hand over the call to Chairman MD Dr. Vikram Shah for his opening remarks. Thank you, and over to you, sir.
Good afternoon, everyone, and a very warm welcome to the earnings call of Shalby Ltd. I am pleased to announce that the company has maintained consistent performance across the key operational and financial metrics. We are present in Gujarat, Western India and Northwestern India, and we are the biggest in Ahmedabad, we are biggest in Gujarat in the corporate hospitals, and we are biggest in Western India in corporate hospitals. With our recent acquisition in Delhi, it is going to make a huge difference for us for international business, as this hospital in Delhi is doing 70% of its work international, and they are leader in liver transplant, bone marrow transplant and kidney transplant, and also onco surgery. Now onwards, our more focus will be beyond joint replacement on cancer, onco surgery, onco medicine and radiotherapy, and we are going to invest some amount in radiotherapy machines also. Also, transplant surgeries, we are going to increase across the group. As you all are aware that we are number one corporate hospital group in joint replacement surgeries across the world. And we are maintaining it for last 20 years. And we will continue to maintain it. As far as these quarter's results are concerned, I am very happy to announce that our company has done great job. And all our senior people are here and they are going to take you through results now onwards. May I introduce Deepak Anantkrishnan, who is head of our implant business. He will take you through implant business now.
Thank you, Dr. Shah. Good afternoon, everyone. During the first quarter of this financial year, our implant business made significant progress, generating revenues of INR 259 million, up by 58% growth, with contributions from the US and OUS at 44 and 56% respectively. We are actively focused on bolstering our team with skilled professionals, transitioning our sales mix to retail customers, enhancing operational capacity and efficiency, expanding our product pipeline through extensive research and development efforts, and significantly reducing procurement costs. The reception of our Shalby advanced technology implants in hospitals across all markets that we have launched has been highly positive, and we have received additional orders from the Indonesian market. With our key strategies firmly in place, Our team is fully dedicated to executing these plans flawlessly. Shalby is well positioned to achieve double-digit growth with sustainable profitability, while also expanding and deepening our presence by opening up new geographies. These efforts will ultimately drive the creation of sustainable value for all stakeholders at Shalby. Like I mentioned last time, the 4 different pillars that we are focusing for the year. Number 1 being sales. Sales in the US is looking at coming on board to get to an $8 million from the last year number of 4.8 million for the year. We are looking at getting to this by onboarding more distributors, sales team, as well as marketing efforts. We are also talking about participating in large congresses, initiating digital marketing, etc. OUS sales, we're looking for another $8 million with the right products across Southeast Asia, Latin America, and other countries where reimbursements are higher than India at this juncture. Cost reduction is the second pillar. Looking to end the year at a cost of 50 to 80% reduction across portfolio by improving efficiencies, shift times, processes, new vendors and suppliers onboarded. This is an 8 to 12 month project, but actions have already been taken and things have started to show up, including the current quarter that went by. The third pillar being capacity. Currently, we are dependent on one vendor or one supplier for every material, and hence if cost is high as well as business can get affected when our supplier has issues. So we are planning to have a multi-vendor system with higher capacity contributing to a sales forecast. With higher volume commitments to double our sales, we have initiated and onboarded new vendors with lower cost as well as increased capacity. This will also help us protect business continuity. The last one is new products. This team is looking at working for today, next year and 2 years down the lane. We already hired the head of engineering and the team is being built and also surgeons are being onboarded to support the new product initiatives. We have also initiated and formed SAT India, where already we have started including on hiring engineers in India who will be working on some of these new product developments. Split into 3 parts. The new product is around, there are products which we will have to build from scratch, like our Gold, which is already gone for our US FDA approval. Ambition, where we've already got the FDA approval for the implant, but we're waiting for the instruments to come through. And then eventually our Tough Gold, which is expected to launch. We are also building improvements in the current system, right from adding additional SKUs in the current product, improving our instrument set. We're looking at a huge growth coming in from the ambulatory service centers, which are called ASCs in the US, and hence to create the system to cater to the same. More sleek and improved instrumentation needs to be done. This will all increase our sales of our current product. Every new SKU still goes through a wear test and regulatory test approval and needs to go through a whole FDA approval process. We also have a new design product initiative, which is in terms of building a revision knee, revision hip portfolio, dual mobility, medial knee. All of this are 2 to 3 years project if we kickstart the work this year, which we have already initiated with the engineering team. So with sales growing up, costs coming down and capacity built to drive growth, I think we are home. New products are important to make sales grow from short as well as long term and also put us in good spot from an innovation standpoint. With this, I would like to hand over the call to Mr. Amit Pathak for company's performance in this quarter. Over to you, Amit.
Thanks, Deepak. Good evening, everyone. I am pleased to welcome you all to the Shalby Q1 FY25 earnings call. Now I will walk you through the financial performance of the company for the first quarter of FY25. The consolidated revenue of 289 crores for Q1 FY25 versus 240 crores in Q1 FY24, and we have been grew by around 20% on YOY basis. This is the highest ever revenue what we have clocked in the history of Shalby on the consolidated level. EBITDA of 55 crores in Q1 FY25 versus 48 crores in Q1 of the same period, with the margin of 20% in the current quarter versus 19% in Q1 FY24, and we have grew by 15% on YOY basis. PBT of 30 crores in Q1 FY25 versus 33 crores in Q1 FY24, and we have been de-grew by 8% on YOY basis. PAT of rupees 15 crores in Q1 FY25 versus rupees 21 crores in Q1 FY24. Our YOY basis our performance excluding the Sanar business, which has been acquired into the last quarter, that is the quarter 4 of FY24. So if you exclude the Sanar business, on YOY basis, our consolidated performance, the sales has been grew by 10%, EBITDA by 16%, and PBT by 10%. So the degrowth in the PBT on the consolidation level due to we don't have the comparable number of Sanar into the last year of the same financial year. The group continued to maintain a very strong balance sheet with the low gearing ratio of 0.18x, which is on the equity of 909 crore with the net debt of 168 crore. Now I will run you through the standalone performance of the hospital business. Standalone revenue of 240 crores, which is the highest ever revenue on the standalone basis into the last 30 years. In quarter 1 FY25 versus 216 crores in the quarter 1 FY24, and we have grew by around 11% on the hospital business on YOY basis. EBITDA is 58 crores in quarter 1 FY25 versus rupees 50 crores in quarter 1 FY24, with a margin of 24% in the quarter 1 of this year versus 23% of quarter 1 of the FY24 quarter 1, and we have grew by 17% on YOY basis. PBT of 46 crores in the current quarter versus 40 crores in the same period of the last year, and we have grew by 15% on YOY basis. And PAT is at 31 crores in this quarter versus 26 crores in the Q1 FY24, and we have grew by 16% on YOY basis. At standalone level, again, we continue to maintain a very strong balance sheet with a positive net cash of 63 crores. And on the operational side, from the hospital business, which includes the Sanar business also, the inpatient and outpatient and surgery count has been grew in the range of 10 to 13% on YOY basis. ARPOB and ALOS has shown a significant improvement, and our ARPOB is 43,365 and ALOS is 3.7 respectively compared to 38,000 and 3.97 in the same period of the previous year. ARPOB on YOY basis has been grew by around 14%. The number of occupied beds has increased over 7% on YOY basis, and the occupancy rate of 48% in the current quarter due to acquisition of Sanar. Occupation at Shalby Ltd, excluding Sanar, has remained at 50% in both the periods, that is into the current year and same period of the last financial year. The payer mix for the entire hospital business, for the sales, it is around 35%, insurance 41%, and government business is 24%. Now, from investment point of view, our capex for the acquisition of Sanar is concluded, and in future capex will be incurred for the capacity expansion of 130 beds to 200 beds into the coming year from the Sanar prospect. Post our acquisition in Q1 FY25, Sanar has contributed top line of 23.77 crores versus top line of 20.42 crores with a growth of 16% on quarter-on-quarter basis. The EBITDA loss for the quarter is 35 lakhs only, and we are confident that EBITDA positive in coming quarter with the increase of scale of operation. Sanar is presently operating at 25% occupancy level, and it will increase gradually in coming quarter. In current quarter, 56% of the revenue contribution of Sanar is from the international patient, which is low compared to the last quarter due to festive season into the Middle East during the month of April and May, from where most of the international patients flow, and we are confident that in quarter 2 business from international patients will increase with the more footfall from the Middle East countries. Revenue from international business remain at 15 crores, which contribute 13 crores from Sanar and 2 crores from the Shalby in the current quarter. I am happy to mention that the acquisition of Sanar, our international presence in other geographies has been increased, and now we have 23 OPDs as a group across various international locations. I am very hopeful that with this strategic location, we will have to increase our international hospital revenue significantly in the coming quarter. At Shalby, our undivided focus has been on demonstrating our clinical excellence through successful execution of many diverse clinical surgeries in several of our hospital units. We also take pride to share that we have successfully completed 29 transplants, which includes 9 kidney, 15 liver, and 5 BMT during the current quarter of FY25. Our SOC franchisee business delivered an adequate performance into the current quarter. The total 329 surgeries has been performed at SOC units, both under the FOSO and FOSM in the current quarter. The total revenue from the photo business is at 2.6 crores, which has been grew by around 73% on YOY basis. Total revenue from the Cosm business is around 80 lakhs, which has been degrew by around 30% on YOY basis. In last quarter of the same financial year, the Cosm revenue includes the project consultancy fees of 40 lakhs in Cosm business, and by excluding that also, the Cosm business has been grew by around 12% on YOY basis. Our next SOC unit at Rajkot is on satisfactory progress and is expected to get operationalized into the current quarter. We have been incredibly selective in our choice of potential partners. The many inquiries that we are receiving so far. To maintain the reputation of our strong brand, we follow a clearly defined process and strict criteria while making these selections. Looking forward, a strong sense of optimism about the seeing positive development into the upcoming quarter of this fiscal year. Our primary focus remain on utilizing our expertise and excellence in orthopedics with the goal of establishing more than 40 franchisee hospitals across India within the next 4 to 5 years. For our home care business, we have served around 7,302 patients in Q1FY25 versus 7,695 patients in the last quarter of the similar financial year. Revenue from the home care business is at around 3.8 crore in the current quarter versus 3.7 crores in the similar quarter of the last financial year. As a part of our social commitment, we continue to spread awareness about the importance of health and well-being through various social media platforms and created 138 plus healthcare videos. We also conducted more than 65 healthcare camps and 155 plus healthcare talks across all our units during the last quarter as a part of various community outreach programs. Shalby also takes pride in nurturing young talent through our Shalby Academy vertical with 1,700 plus students registered in various healthcare programs during the current year. Our SAT implant business has delivered minimal EBITDA loss of rupees 66 lakhs in the current quarter due to marketing, sales promotion and other allied expenses incurred during the quarter for the upcoming products. Our operational efficiencies in improving quarter-on-quarter basis with the optimization of the procurement cost. The revenue is at the moderate level of around 26 crore in the current quarter versus 16 crore in the quarter 1 FY24 with the growth of 63% on YOY basis. With that, I will hand over the call to the moderator to open the forum for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you have any questions, please press star and 1. Our first question is from the line of Rohan Vora from Envision Capital. Please go ahead.
Hello, am I audible?
Yes.
Yes. Thank you for the opportunity. So, sir, my first question was on the implant business. So, what is our current COGS for the implant business?
Current CAGR for implant.
So, current cost of goods sold percentage for the implant business?
Oh, our current cost is in the range of about minus.
So the product to product is different, okay, because we have the different kinds of implant for the knee and hip. So it all depends upon the product mix. But if you are looking after overall cost, including the overhead which has to be allocated onto the material cost, it is close to around 25 to 28% based on the product mix.
Okay. And just one more question on the ARPOB. So the ARPOB this year have been 43. This quarter have been 43,000 plus. So what contributed to the ARPOBs?
So there are two parts. One is Kanar has the very high ARPOB, and Kanar have around close to 75,000 to 80,000 ARPOB. And in Shalby also, the high mix also contributed in terms of the ARPOB of this current quarter.
Right. I'll get back in the queue for further questions. Thank you.
Thank you. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Hello. Hi, sir. Thanks for this opportunity. We just wanted to check the Sanar Hospital. Now at a 26% occupancy level, what we have seen is more than 50% of their revenue is generated from the international patients. So, how to think about this in terms of profitability? So, knowing the fact that the margin profile of a business, which is heavily dependent on the international patient, is generally higher compared to the normalized margin mix. So, at a optimal occupancy also, the revenue mix from the international patients are likely to remain at this level or should improve. And if that would be the case, then what is the margin profile and how superior margin profile this hospital can generate compared to our blended margin that we have been reporting?
So thanks for the question. Mr. Naresh Kapoor, who heads, the northern region, he is also on the line. I think he'll be happy to take the question.
Yeah, thank you, sir.
Hi, good afternoon, everybody. So, coming to the question put up by Surya, we expect the mix of international and domestic business similar to what we have been doing right now, which is about 1/3 and 2/3. So 2/3 international, 1/3 domestic. It may, since domestic, we have recently tied up with all the TPAs, so it might increase a little bit, but no major difference should be expected. And with regard to the margins, yes, I agree with you that the margins are higher because of the higher end surgeries that we perform, and that also will be, in future also it will remain higher as compared to the other hospitals.
Okay. So then this can play a kind of margin booster role for the company as a whole.
Yes.
Okay. My second question is on, let's say, about the arthroplasty revenue mix. So obviously, with the more and more other therapies seeing a kind of a progress, the arthroplasty revenue mix has to some extent shrunk in this quarter on a YOY basis. So whether it is adding to the overall profitability, how should one think? Because in one way, the arthroplasty is getting complemented by the captive implants also. And that is in our forte. And now the other therapy-related services, if that is rising, then in terms of the margin, what change that it can bring?
So, this year you're right. Arthroplasty business as a proportion to the overall business has gone up. So if you exclude Sanar, which has been a recent addition, we are at about 47% of arthroplasty work in this quarter. And yes, that has shifted the ARPOB of the company, for this quarter. In terms of, using our own implants, at the moment we are using only about 10% of our own implants in Shalby as a group, as we are in the works of trying to sort out our supply chain and ensure that we are able to get the product in sufficient quantity for us to be able to put it out, because we are into the external market in the US, Indonesia, Japan, and other parts of the world. So, at this point of time, we are working on ensuring that, we do not fall short of supplies in the other regions. And, of course, we will be working in the next 12 months. We are very optimistic that about 70 to 80% of Shalby's consumption will be used. We will be using the SAP implants, within the arthroplasty business. In terms of the profitability, yes, the profitability of the arthroplasty is naturally more because, we are the largest player globally in terms of the volumes
that we are doing. Having said that, some of the other specialties also are very highly profitable for us. So, I would not paint the whole thing with the same brush.
Okay. Yeah. Just last one question, sir, from my side. This is regarding the home care business. So, in terms of the number of patients served, what we are seeing in the presentation that there is a decline YY. So, since this is the business which is kind of at its nascent stage and should be seeing a kind of a progressive or steady progression only, why the number of patients served should be declining?
So the home care business, basically, if you can see into the last all the quarters, the patient growth has also been there, and also accordingly we have a top line growth also. In this quarter, there is a slight reduction into the patient into the home care business, and there is not much of the improvement in terms of basically the revenue. But this is the one of the quarter where we have the low patient. But going forward, we are seeing the growth into that business what we have projected.
Okay, so this could be a aberration just in terms of the quarter, or there is some sort of seasonality is there here in case of home care.
Some sorts, there is some operational hiccups was there for some period, but that will continue to grow, and we are growing very fast into the home care business, and this year we will grow into the similar line compared to the last year.
Okay. Yeah, sure. Thank you, sir. Wish you all the best.
Thank you. The next question is from the line of Bino Pathivarampil from Elara Capital. Please go ahead.
Hi, good evening. Just a clarification on Sonar. In the opening remarks, you said there was a loss of 35 lakhs there for the quarter?
Yeah, loss of 35 lakhs on EBITDA level.
At the EBITDA level. Post or pre-Ind AS?
Pardon?
Post Ind AS or pre-Ind AS?
It's a post Ind AS. And just to reflect you, the Ind AS impact is coming in terms of the lease rentals, which will go below the EBITDA level.
Understood. And what is the outlook here? When do you expect this to fully break even and may start generating profits at a PBT level?
So, Mr. Naresh Kapoor can take that.
Hi. So what we expect is that EBITDA level next quarter onwards, we should be looking at break-even at EBITDA level. And overall, by this financial year end or maybe early next financial quarter, we should be able to reach the overall break-even outcome.
Okay. Great. Second, in your presentation, you give a standalone revenue and EBITDA. So, which all are the hospitals which come in standalone?
So, on the standalone business, we have all our hospitals, including our franchisee business. On the console, we are just including the Sonar business.
Okay, understood. And for the implant business also, would you please give some guidance on profitability? Because last year we had almost broken even. This quarter again we have gone into a slight loss at a EBITDA level. So what is the profitability over the next few quarters?
Yeah, so I think the implant business is on the right track. If you look at it, there has been a significant growth upwards of 60% in the quarter versus the last year first quarter. The reason why you see that negative EBITDA is fundamentally front loading of a lot of marketing and sales activities that we are doing. We're preparing ourselves for a couple of new launches by end of this year and stuff. So there was a lot of efforts from that standpoint. And also because we were doing a lot of contracts and other things, we also had a slight upward expense on legal, which is, for this quarter, which was also a hit on the EBITDA. But going ahead, I think we are on track. So, like I said, our sales is growing and our COGS are going down. So you will start seeing quarter on quarter results starting to fall in place.
Got it. Thank you. I'll join back with you.
Thank you. The next question is from the line of Rohan Vora from Envision Capital. Please go ahead.
Thank you again. So just wanted to check on the margin side. In addition to Sanar, were there any one-offs in the margin? And another question was on the Udaipur hospital that we discontinued the partnership. So what was the reason behind that?
Yeah, so at the standalone level, we basically have expanded the margins. So even though the top line has grown 11 to 12%, the margins have grown in excess of 15%. So there has been a margin expansion, and there has not been any one-off. So you can expect that kind of operating leverage to play out as the revenue and occupancy grows in the standalone hospitals. With regards to the Udaipur franchisee, there was non-compliance at their end, and we were left with no choice but to cancel the agreement.
Right. And if I can just squeeze one more here, what was the reason for, earlier we said that Rajkot would be operational by Q1, and now we are saying Q2 FY25. So any reason for the delay?
No, there is no reason for the delay. It's just that we have started doing camps, and essentially the soft launch is already being done. So we are going to, the work has already begun, and we will have a full launch in Q2.
Okay. And any other franchisees, you are looking at, and we can see them getting added soon, anything like that on the cards?
There are several in the pipeline, but unfortunately we are unable to share, as they are still, we are still in the discussion.
Okay. Thank you so much for the opportunity. Yeah.
Thank you. The next question is from the line of Raja Kumar Vaidyanathan, who's an individual investor. Please go ahead.
Yeah. Good evening. Thanks for the opportunity, and congratulations for the good set of numbers. Sir, I have 2-3 questions. The first question is on the tax rate. So if I see the tax rate on standalone, it is about 34%, and console is about 50%. So that seems to be on the higher side. So just wanted to know what is driving this higher rate.
So basically, if you can see that in the tax level on the consolidated side, we have the two hits. Basically, the hit from the Sanar and our implant business, which is coming around that. And if we're talking about in terms of the interest and finance costs, what we have in Sanar, we have the finance cost of 168 lakhs for the quarter, and in the implant business, our finance cost is around 370. So which is reducing the basically bridge between the EBITDA and the PBT.
No, sorry, sir. My question is on the tax rate.
Okay, tax rate is around 33%, what we have.
Yeah. So 33 on standalone and 50 and 50 in console.
Yeah, so I'm coming to that. So tax rate on the standalone is around 33%, and we are under the MAT, and MAT is getting utilized during this financial year. Now on the consolidated rate level, the tax rate is low because we used to create the deferred tax assets on both our implant business and also the Sanar business, which we have stopped, and we want to go conservative. So that is the reason we have not created that deferred tax on these assets.
Okay. And so when are you moving to the new regime? You said the 25% tax rate on the standalone.
So the tax rate, the MAT will be there. MAT adjustment will conclude in the current financial year. So from the next financial year, we are into the next new tax regime.
Okay. So you're guiding similar rates for the subsequent quarters also for the tax rate, given this situation of losses?
Yeah, on the consolidated level, we're not going to create the deferred tax for these two entities.
Okay, and can I know what is the DTA benefit not recognized till date? Do you have that number?
So I don't have a handy number that I will share with you later on.
Okay, great. So the next question is on the COGS. If I look at the material plus OPEX to the sales, that has gone up to 58% in current quarter vis-a-vis the fourth quarter of FY24. But there was a talk in the previous call that you are planning to bring down the COGS. So just wanted to know what is driving this 3% increase in COGS. Is it more a mix change or?
Can you just repeat this? You are talking on the standalone or console level?
Console level. If I add the material consumed plus OPEX, then that stock and trade change in inventory.
Yes.
I take that to the sales, it comes to 58%.
So look, if you can see, if you just to give the guidance, if you can see the standalone, there is not much of the deviation on the YOY basis. On the consolidated basis, just to give the breakup of the two things, consolidated include the Sanar business and also the implant business. Sanar cost is in line, or I can say slightly lower compared to our hospital business. So that is around close to 22 to 23%. So the variation is not coming from there. The cost is coming high in this year. Basically, if you can see, there is not any change in terms of the movement of the inventories, which has been there, and we are building up the inventory. So that is going into that, and that is the reason that is impacting some of the cost, which is going out from the implant business.
Okay. And sir, your other income has also gone up to almost 96 million. So can you just give the components? Is there any one-off sitting here?
It is for the couple of things are coming from the Sanar point of view, where we have taken certain kind of one-off discount from the old receivable from old vendors, what we have been taken. And there are some rentals and other income and some promotion income is coming, so that has been increased.
Okay. And sir, lastly, the finance cost also going up. So just want to any guidance you can give on that number.
So finance cost is going up. Basically, you can see is on the standalone level. For the Sanar acquisition, we have taken the 100 crores of loan. So that is the reason the finance cost on the standalone entity is going up. On the consolidated level, if you can see in this quarter, the finance cost has gone on YOY basis because, as I mentioned, Sanar finance cost, the lease cost has been included into the cost. And apart from that, as we are building our implant business, where we are building the inventory and lot of working capital requirements are right now is going on. So we have that kind of cost. In the current quarter, we are continuing with that kind of finance cost, and from next year onwards, once the implant businesses will get stabilized, the working capital interest on this implant business will come down.
Okay. So any guidance on this number? Will it be flatlined at current levels, or it will come taper down?
It will slightly increase. It will not be the flat line. In the implant, we have to invest more in terms of the working capital for the next couple of quarters.
Okay. Thanks a lot, sir. Thanks for answering the question.
Thank you. The next question is from the line of Saket Saurabh, who is an individual investor. Please go ahead.
Hi, thank you. Am I audible?
Yes.
Yeah. So my first question is, within the hospital business, if you say exclude the new acquisition. So what has been our which is Sanar? What has been our blended price hike that we have taken?
Sorry to interrupt, Mr. Saket Saurabh. You're sounding a lot feeble. If you're using the speaker mode, maybe.
Is it better now? Hello.
Much better.
Yeah. So my question is, excluding Sanar in the hospital business, what has been our price hike at the blended level?
Sorry, can you repeat your question?
Yeah. So price hike on a blended level.
Price hike for Sanar or for
non-Sanar, excluding Sanar, the hospital business.
So we steadily, kind of look at price revisions, but it's not like, the price revisions for all the areas happen at one go at one point in the year. So, we look at each segment once in a quarter and assess it once in a quarter. And if any revisions are required, then we take them. But approximately, usually this is in the range of between 6 and 8% in a year.
Okay. So see, where I was coming from is, arthroplasty, which is our bread and business, the volume is also coming down. So, and if I look at, say, some other businesses also like home care, so is there something that we are trying to do to really enhance the volume growth? Because increasingly, if you look at even the competitors, they are saying that price hike is becoming much more difficult now, right? Given the increasing competition. And so are initiatives really being taken to increase our volume, which seems to be slightly on the lower side? Like, for example, our surgery count increased by 8%, when arthroplasty, which is our bread and butter, showed a negative dip. Even home care business, the patient footfall has come down. So I was just wondering if certain initiatives are being taken to increase the footfall or volumes.
Yeah, so you're right, but I think, the way to look at it is that, the inpatient growth, on a year-on-year basis has grown 15%, and the outpatient count has grown 13%. So, these are high double-digit kind of growth numbers in mid-teens. So, yes, of course, we would want to do a lot higher, and, the teams are definitely working on increasing the outreach in terms of the different programs that we do. But, probably occupancy may not be the only measure by which we should, assess the success.
Okay. Therefore, now coming to this FOSO and FOSUM. So now if I look at, currently they are contributing around, say, 3 crores to the top line, which is, say, around 1.5% to the overall quarterly run rate. Now, do you really think it is, and on top of that, we have a business like implant, which is, really doesn't seem to have operating leverage, at least as of now. Maybe in future it might deliver. So, do you think, how are we optimizing our management bandwidth so that, we can really look, so basically, are these franchisee businesses really bringing a bang for the buck, given the kind of management bandwidth that these might be attracting?
Correct. So, in the past, in the last 6 months, there had been few leadership issues, and, they have been sorted out in the last 2 months. So we have a very senior person who's joined us who's going to overlook the SOC business. Having said that, SOC business, the capital employed is very minimal from the end of the company. And, however, it is a promising business because, we are only trying to build on the orthopedic leadership that we have been able to create, for the last 30 years under the leadership of Dr. Vikram Shah. So, and we will continue to do that, and we feel that this is highly scalable. Of course, from the learnings, of the last 2 years, we believe that franchisee-owned shall be operated, that particular model will grow much faster for us than the franchisee-owned, franchisee-operated model. So that is, for the SOC business. And I think from the implant business, Deepak can kind of take it from me.
No, so from an implant perspective, the management bandwidth is pretty well sorted. We have presence now in somebody who drives the US business based out of US. We have someone in Indonesia, and we have an Indian leadership team. So the management of this team, whoever is working on this particular thing, their bandwidth is completely dedicated only to this. So we are on track.
Fair point. Now, so if you look at, say, the franchisee business, and now that you have said that, you have had some learnings, now, say, if you look at, say, 3 to 5 years down the line, what percentage of top line do you think this FOSO or FOSUM or the combination of these two are they likely to contribute to the hospital business, which is currently, say, at, say, 1.5 or something in that range? So within 3 to 5 years, what percentage do you see they would contribute?
So it will still be a very small percentage because if you think of it, what will happen is that the hospital business will continue to grow like it has grown for the last 7 years. You've seen a 20% CAGR growth. It will continue to grow 20% for the next 6-7 years. So, from the existing levels, you will see that this is growing multifold, right? And then the SOC business is basically much smaller hospitals comparatively. So these are 20, 25, 30 bedded hospitals. So, they cannot individually contribute very significantly to the top line, but it definitely helps you build a great brand equity in that particular city. And we should also consider, the kind of patients that will be referred from those towns into some of our flagship hospitals. So, I think if you look at it from that perspective and a slightly holistic picture, it will create a lot of synergies for the hospital's business also.
Okay. But it's so, when you look at these franchises, it's like more like a hub and spoke model. There is a flagship facility and which caters to capabilities from where are really used to cater to, say, some of these franchisees in and around that. Is that the model that we are looking at?
No, that's not be the model. They will be completely self-sufficient. But then what happens is, at times when somebody goes to an orthopedic surgeon, for some kind of treatment, and he's a geriatric patient, there might be other comorbidities that, the patient might be suffering from. And, they can always be referred to some of our flagship hospitals.
Okay. So just one of the last questions. So the manpower that we have at these facilities, these are all full-time stationed at that place or and owned by Shalby. Is that a fair understanding?
Yeah, so I think we have Mr. Babu Thomas, who I think who's basically the group CHRO, and I think what he also kind of discussed a little bit about Shalby Academy and the kind of programs we run there.
Right. Thank you. A lot of questions. Thanks to touching the HR space. We have overall around 3,155 full-time employees, and also we have around 378 full-time consultants, along with around 900 employees on contractual basis, which contains our entire pool of employees across all verticals. So, which also caters to the subsidiaries and all our main business in India. And US, we have around 100 odd employees in US stationed at our manufacturing facilities, and a dozen employees in the field in US and other entities like in Kenya and also in Malaysia and a couple of other centers. This is our employee strength. So as far as employees talent development, training internally, we have a pool of around 20 trainers across the centers here under one assistant vice president. And we also have a simulation lab established in Ahmedabad to train our clinical team for catering to entire 16 hospitals based out of Ahmedabad and other centers in India. And also the academy division, as suggested by Mr. Shanai, we are catering to around 2,000 students are undergoing various programs. And we have partnership with around 6 universities in India. And recently, as a first time of its kind, we got an affiliation to run around 8 courses in our centers in Ahmedabad from Kaushalya the Skill University. So in terms of HR, we are deploying most of the best practices available in the industry to drive a better retention of employees, attracting good talent, and take this business and support all the business entity to the next level. That's what we are all doing from our side. So a lot of good work happening in academy sessions and other HR and training and development across. Any specific question out of this, you can go ahead, please.
No, I think I really appreciate a comprehensive response. So just one small question. So how much, regarding this franchisee model, so do you have a separate team that looks after this franchisee that you are managing across India?
Yeah, we have a separate team.
Okay. Thanks for patiently answering all the questions. Best of luck for your future quarters. Appreciate it.
Thank you. The next follow-up question is from the line of Raja Kumar Vaidyanathan, who is an individual investor. Please go ahead.
Yeah, sir, thanks for the follow-up. Sir, I'm looking at your slide number 11 of the presentation. Sir, there you have given the ROC, annualized ROC is about 16%. So I just want to know, is there a similar metrics that you if you can give that at a console level also, it will be helpful, sir. And also there is some note that is missing. You are referring to some note 1. I couldn't find what is the note 1.
We will get back to you. We don't have the handy presentation in hand. So we'll tell you offline.
Yeah, and sir, if you can also let me know what is the guidance for for the ROC for the upcoming year. You have any number range? Can it be given?
So the hospital ROC will continue to expand from here. And, since the implant business is not yet contributing to the ROCs, it will start contributing to ROCs meaningfully in 3 to 4 years down the line. But yes, you will see that number grow year on year, to get to that level.
Okay. And sir, lastly on the regulatory update, so as you all know that the Supreme Court has asked Center to kind of work with the hospital and standardize all the charges. So just want to know, is there any update on that item?
Update on no. So the next hearing I think is in the next few months. I think it's in September.
Okay. No, you haven't heard anything from the government on that point?
Yeah, the next hearing is in September.
I think it is in August, if I remember.
Sorry, come again?
Yeah. To my knowledge, I remember it's in August. So just wanted to know, are you working with any of the committees with the government? So any progress made on that one?
We are not working with any committee for this.
Okay. So what is the sensitivity currently we have? Do you think our charges are already kind of we are on par with the market, or we are more on the premiumization range, or just wonder what is the sensitivity of the bottom line if there is any change that is brought in by the government?
See, the first thing is that it is very unlikely that something like this will actually translate into practice, right? So that is point number 1. And number 2, if you assess the ARPOBs of most of the listed companies, and if you have access to unlisted companies, if you look at the ARPOBs, we are anyway on the lower side compared to most of them, yet generating higher EBITDA margins, right? So I think we will be the least affected amongst most of our peers.
Okay. That's all I wanted to know, sir. Thank you.
Thank you. The next question is from the line of CA Vikash Vijayvargiya from Econtri. Please go ahead.
Yeah, thank you. So one thing I want to understand, this one is one of the announcement in November 23 regarding of the ointment agreement with the Santa Cruz Mumbai 175 bed hospital. So we already paid the security deposit 37.5 crore. So what is the update regarding this one?
Are you talking about the BCJ hospital in Mumbai?
Yeah, it is Santa Cruz. Yeah, 175.
Yeah. So the trust was responsible for getting the approval from the Charity Commissioner's office in Mumbai, and they put in the application in the month of January this year, and they are hopeful and optimistic that we should be able to get the approval in the next couple of months. And after that, we will be taking the required approvals from the BMC and then proceeding with the building and constructing the hospital.
Then it takes another, after everything goes well, then it takes 2 to 3 years time?
Yeah, so I think from the time they are able to hand over the hospital to us, which seems very likely in quarter 2 or quarter 3 of this year, from the point of handover, we think we should be able to deliver the project in 28 to 30 months.
Understood. And one thing also I want to understand regarding this one is there, our occupancy is somewhere is less than 50% in the last 22 years, 22, 23, 24. And it still is a downside. And in the same time, it's my last content. This one is a speaker also asked. This one is there. We are going to be, because our ARPOB is increased from the 38,000 to the 43,000. So this is not an issue for us, because whatever your ARPOB is lesser to be comparable in the listed player. But our occupancy is still less than 50%.
See, there are a couple of things. I think, one is that I don't think we should assess the success only based on occupancy, because, over the years, the average length of stay has been coming down significantly. So, that will affect your occupancy number if patients are getting discharged faster, right? This is one. The second point is that as we keep adding beds, like, for example, we added Delhi, right? Now, when we add Delhi, you will be seeing that, we've added the number of, we have increased the bed capacity, right? And at the same time, the operational beds over there are much lower, and, the occupancy there is much lower. So you will see that, because of these additions, there will be a kind of slight dip in the overall occupancy percentage level, right? But if you look at the overall growth, the way I would look at it is that, the inpatients have grown, inpatient count has grown by 15%, the outpatient count has grown by nearly 15%, which I think is a very healthy growth, along with an average 4 to 5% ARPOB growth, which is giving you a near 20% kind of top line growth.
The surgery count is already increased, sir. Because it is 7,700 total right now, so almost is 9,000. Surgery count is drastically changed in the quarter to quarter. Only that means because whatever the self-pay patient is 35% in our cases. So 65% is the government and the insurance patient is there. That means a slightly increase on prices is there, as per my understanding, sir.
Sorry, what's your question? I'm not able to get it.
No, not an issue, sir. Okay, thank you.
Thank you. The next question is from the line of Kashish Thakur from Elara Securities. Please go ahead.
Thank you for the opportunity, sir. Mostly, all of my questions have been answered. Just one question. What has been our percentage of international revenue from the international patients, excluding Sanar?
So for this quarter, it's around 2 crore.
So this is excluding Sanar, right, sir?
Excluding Sanar.
And including it?
It's around
15 crore.
15 crore.
Understood, sir. Thank you so much, sir.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you, everybody, for joining the call. We will connect again into the next quarter. Apart from that, if you have any questions, you can reach out to investor email ID. Thank you.
Thank you. On behalf of Elara Securities Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.